Okay. So, good morning, everyone. Welcome. So, yesterday we started with cash flow. Cash flow. And let's like a recap of what we did yesterday. So, try with cash flow. We've been able to see the meaning of cash flow. Look at the cash flow in terms of without being the operating, investing, and financing. All cash flow we have that big operating, investing, and finance. Also, these guys have two types: direct and indirect. Direct and indirect cash flow. Direct cash flow, I think, look at how it looks like direct and indirect. And the main difference between direct and indirect is the way your operating activities is being prepared. So investing and financing for the what they will do. So we now look at the different items that are related to the operating, investing and financing. Operating has to do with daily activities, things that they don't be engaged is what they do. Kind of operating activities. That's what the business does every time. That they really then investing has to do with disposal and acquisition of assets. While financing has to do with changing the capital structure. There are changing the capital structure, we're going to see equity, your debt, and your stock. Then we now further went into some important parts like interest received, interest paid, which other one? Dividend received and dividend paid. Have you saying what you look out for is the going IFRS and what the capital is? Those remember of this dividend paid and interest paid under IFRS categorized as operating of financing, while raw dividend received the interest received categorized as operating and investing. Then we went into years that everything is operating except dividend paid, which is financing. So I think we put that and recap before we click. Then we said that two means there are non-cash items, non-cash operating items. The categorize them under operating and while non-cash investment and activities which you don't involve in the cash flow calculation. What you don't do is put them on that groups. You guys still remember all this? I will put please remember all this what we did this. Yeah. So we now further went in and said that whatever we do in our agree that item is come into your cash flow. Whatever you do in our profit or loss, profit and loss balance sheets, we do the opposite in cash flow. So we now give a very good example of depreciation. Depreciation, you are subtracting it, add it back, as whatever the organization you are subtracting it, add it back to your cash flow. So whatever you do, the opposite side is the public cash flow. Because they are trying to get your true cash position. Your true cash position. I will give a very good example of increase in account receivable. Increase in account receivable. If there is an increase in account receivable, normally your balance sheet is a good one because your asset is going on. Since it's a good one, I will say we do the opposite in the cash flow. So what we are supposed to do now is just do the opposite, which is going to be negative in the cash flow. And I said, you can't remember any other thing, just remember this particular one. Once you remember this particular one, turn the other one upside down, then you are fine. So if there is going to be decrease in account receivable, you add back. If there is going to be increase in account payable, you will add, then decrease in accounts payable, subtract. Okay, we now that went into please don't forget this particular one, the sign that it is cash collected from customer, cash collected from customer, cash collected from customer is what? The sign that means money is coming in a bit. Yes, whatever you are doing, just first put the sign first before you put your figure. while cash paid to supplier is an outflow. Yes, it's an outflow. So whatever you're doing, first put the sign first. Once you put the sign, you can now start putting your finger. Please, this is very important. Please don't let your weight. So let's move to the next slide about, like I said, the one major difference is the direct and indirect cash flow. The direct and indirect cash flow. With the direct and indirect is the operating activities. That's the main difference. The operating activities. Okay, so now let's take up each one of them. Let's start with the direct operating activities. Direct operating activities. Please, let's pay attention. So your question can come like this. Your question can come like this. It can tell you to calculate for direct operating activity for your operating activity for direct method. They will give you a question of operating activity for direct method. So how do you go about it? How do you go about it? So operating activity, like I said, the main difference between direct and indirect is the operating activity. Operating activity. Operating activity. And so we now look at the operating activity for both methods, then investing and financing will be the same for both methods. So for direct method now, for direct, please don't forget the sign. Don't forget the sign. So the first thing you need to know, is there's something called, just remember these short words. Just remember these short words. C, which is your cash collected from customer. Cash collected from customer. You know, like I told you, if it's cash collected from customer, what will be the sign? Plus. So you put your plus, or you put your figure. Cash paid to supplier, what's the sign? Minus. Cash paid for operating expenses. Is it positive or negative? Negative. That's the thing. You put the negative. Cash paid for taxes. Is it negative or positive? Negative. Cash paid, which one again? Cash paid for interest. Is it negative or positive? So just remember this C, and that is for direct. So now, the question can come like this. It can give you a question to calculate your C short T, which is your direct operating activity, or they will give you a particular formula to calculate one of these parameters. Maybe it's collected from customers, to suppliers, to operating activities, to taxes, or to interest. So that's how the question would like to come out. So then we do the example. You guys can please, if there is any questions, you can stop me at any point in time so that I will not close to go to and follow all that information. Okay, please, so let's take note of this example. We must write. So let's write. So let's write. So your revenue is 100. Let's write. Your revenue is 100. The revenue is 100. The revenue is 100. Your beginning account receivable is 20. The beginning account receivable is 20. Then your ending account receivable is 25. Your ending account receivable is 25. Calculate your cash collected from customer. Calculate your cash collected from
So if you don't confirm the cost like
20.
okay, the end was
25.
25.
Yes.
And then the that I think it was
Revenue control.
100.
Yeah, so calculate your cash collected from customer.
Next five.
25. Have you, has anybody else got 95? Okay, yeah. It's perfect. I'm not going to go to 12. So now let's do it together. Remember the rule, so let's do it together. C short, yeah, cash collected from customer. So if it is cash collected from customer, what's the first rule? What is that inflow and outflow? Inflow. That means money is coming to. Remember the sign first of all. Let's put the sign. Do you remember? So we're now told that we now use the other parameter. We're told that revenue is what? 100. Then increase in accounts, and beginning account receivable, account receivable is what? 20. Then ending account receivable what? 25. Oh, good. So this is what? So let's now take it one by one. So revenue. So we put the sign, Abby. What's the revenue? 100, Abby. We are told that if you started with 20 and you are ending with 25, is that an increase or increase? Increase of how much? 5. Then there is increase in account receivable. What do you do to that? Yes, which is what? No? Is it minus? Yeah, so you increase that. So your cash so right. That would be what? Minus what? Yeah, that's what it is. Minus 5. So what's our answer now? 45. 95. No, it's just one. You can look at it together. Since you started with this, now ending with it and increased from 0 to 25. So it's one increase like 5. So I will find everybody. So these are the way the question can come. So let's do another one. Let's do another one. Let's do another one. I will together everybody goes online. Can you hear me? Okay, so cost of goods is 100. Cost of goods sold is 100. Cost of goods sold is 100. Inventory at the start is 0. 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 Ending inventory is 10. Ending inventory is 10. Ending inventory is 10. Account payable, beginning account payable is 20. Then ending account payable is 25. Ending account payable is 25. Beginning account payable is 20. Then ending account payable is 25. Calculate the cash paid to suppliers. Calculate the cash paid to suppliers.
I got it.
95. Okay. Anybody else? Minus 95. Okay. Okay, so let's see the question you guys have. Cost of goods sold is what? Inventory at the start is 0. Then inventory at the end is what? 10. Account payable at the beginning is what? 20. Then ending account payable is what? 25. So we are waiting for one more person. Okay, so let's solve it. Let's solve it. So, what are we calculating? Cash put to what?
Cash paid to supplier.
Cash paid to supplier. So if it's cash paid to supplier, is there an inflow and outflow? Outflow. So what do we start with? Minus. So what's the next cost of goods sold? 100. So what's the next one?
Then beginning account payable.
Beginning, no. The inventory.
Zero.
At the start is 0, then at the end is what? 10. So if there is an increase in inventory, what do we have?
Increase in the value.
So you subtract it at the.
But you might consider about
It's the same thing. It's current asset. It's current asset. Those are like you would say, am I doing what you did? So if there is an increase in your current asset is inventory, current asset is receivable. There's an increase in your current asset. It's a good one for your balance sheet, but you subtract it to your cash value. So it's going to be minus what?
10.
Minus 10. While payables. Payables, what do we have in payables?
Beginning payable 20.
The ending payable 25. So that's an increase in payables too. Right? There's an increase in payables. What do we do? I just write it down. Do we agree? We add it. Do we agree?
Yeah, I think it's
We add it, Abby. So let's add that plus 5. Yeah. Minus 100 minus 10 plus 5.
Then
minus 1.
Thank you. So you might not see minus in your answer. If you see 105, it's the same thing of this. Do you understand? So that's it.
Yeah.
It's the same thing. I thought it's receivable and inventory. They are current assets. So whatever rule applies to your current assets, your receivable applies to your inventory. Does it make sense?
Because the cost of goods sold is more like money inventory can be.
You know, like I said, if you model the financial statement, inventory links to cost of goods sold. Even payables links to cost of goods, but payables to more of your purchases. Do you understand?
I'm still very confused.
Oh yeah, let me
Now, I'm looking at the cost of goods sold is but I'm trying to take
or when you have inventory, what do you cost of goods sold?
yes. But that inventory amount.
It's your asset.
And so I don't know how to trace it. Whenever I'm talking about cash flow.
When you your balance sheet, you have inventory. And it's your current asset. You will say anything that is current assets. Anything that is current asset. That you are included it comes to your cash flow. It's the opposite that is like paid for cash flow.
Okay. But the money from you that inventory is part of the cost of this.
So inventory, listen, so you inventory as stock. Your stock. Have a stock that you have in your inventory. So it's an asset to you. So you are selling a Coke now, Fanta, bottle of Coke. $. Normally, do that, you say so that get cash. Likewise, you do that, basically, your customer can be reducing money so that get cash. So if you have 10,000 bottles that are on yet to be sold, and then you don't expire it, you'll be happy now. Like, oh, you better go and sell this people.
The average cost of goods sold is just you want to.
So once you sell your inventory, it flows to your cost of goods sold. You get it now. So once you sell your inventory, it flows to your cost of goods sold. But if you not yet sold, it should stay at the inventory. Make sense, I mean? Until when you sell your inventory, then it now flows to your cost of goods sold. Likewise, you are going to see people in your revenue. It is when you sell, or when the customer returns your money, that it now flows to your revenue. Yeah, so the link. But you can still recognize revenue without the person paying. You know, we told you there are three forms of revenue: credit, cash. The person will first to pay it down. Okay? But you're giving the person who's not over the revenue. There are different types of revenue. It was like the post is everyone comes. I know there is rules for that revenue recognition. Remember, yes. So there is rules for that revenue recognition. For us to recognize that we have to still with the government. And
I was confused when I even
even if it's not like person change, when you start when whatever you are doing at your company, I mean you are selling you don't meet or whatever. It's when you have to stop available. You understand? You will not let it stay like oh, there's this thing called this stock order or something like that. I can't remember what you should tell that and cost accounting. You understand? So when there is you now request for if you know like help me guys now, what do we call it?
It call was what it
Yeah, they are not with us.
is.
So we said, you know, there is something now if just stock out. Instead of you stocking out, is that is it the other level or something like that before you stock out or something like that, so you don't stock out?
Yeah, I think so.
Yes, I think the other level. You know, before you so you have to have very good accountants that will be able to monitor before you stock out and time to the other. So that the customer will not come to you that I will give things and go around. So you are saying you do it now. You know this to the last two what's it called? Yes, two back at the end before you start you start making it, you know. So you notice that oh, every month we give 10. You have started to give trade flows, except the exceptional notes that people decide to be eating the new thing. You understand? You understand? So just so once you really that the other level or maybe that level that say when you get to that it's very nice. One people will stop in it. Because we will make this part of the cost of construction.
only when we sold.
Really when you're able to sell and get cash and now for it to your cost of construction. So most of the key inventory are able to sell. You will not put it off like any cost instance. You understand? Because when you now do that, you're able to sell again. Okay, let's take up one more. Let's take up one. So, from your interest expense is 50. The interest expense is 50. Your interest expense is 50. There was an increase in interest in increase in interest in increase in interest in foundation of high increase in interest paid. Yes, by increase in interest paid. Yes, by okay. Okay, that's the answer. This one. Do you understand the constant? Yeah, that's the constant.
I don't think that you got those important, for example, interest expense with benefiting plus so it's possible to really without benefits in the room.
Yes, you know, like I said, it is an if we don't notice inflow and outflow. If it is outflow, money is going down. If it is inflow. So this kind of question falls down a lot. You see, when we start curriculum questions like in back, almost all the questions is like this. So imagine one does not know it. Yes. Imagine one doesn't make mistake with the sign. Do you understand? People you might have a different way of solving it, but I think this method is better. For me, that's what I feel. You get what I'm saying? That's what I feel generally.
Yeah.
I know people have their own techniques, but once you plug, you just do the sign, plug it in there, move on, get your answer. So that's what I feel generally. That's what I feel. So that is our, so the question can come in different format. They can give you cash collected from the customer, cash to supplier, operating, which are, will tell you calculate your direct cash. Just put your plug into your fine. So any questions so far? Any questions so far? Any questions so far? Okay.
One question though.
Yeah. Mr. Michael, you're welcome. Are you with us? What we are fine with hope you join us today so that you understand the needs that part. Okay, so that is the direct operating method. So the indirect method now. Indirect, that's the one people are familiar with. But direct method is better. And even all the standard, USGAP, IFRS, they encourage you to do direct method. Because it breaks it down, you see the flow of your customer, your supplier, your expenses, to the present spend, your taxes, before you now finally arrive at the operating cash flow. But looking at it logically, very directly, because you can add all these things to your net income. For the customer, they will not see the movement of your customer, your still supplier. So everybody just wants it all under your net income. And another thing that people find difficult is how to prepare this directly. Most people don't know how to prepare it. Very difficult to prepare. That's why they don't want to do that indirectly. This is the indirect method. So the indirect method, that's what we are familiar with. Indirect method, that's what we are familiar with. So I can rub this up now, right? Indirect method. You start to net income, with your result. Are we together? You adjust for your non-cash item. Non-cash item. Who can tell you non-cash item that we know of? Operating non-cash item.
Operating.
Yeah. So which was not like depreciation, I mean. Yeah, it's depreciation and amortization. I don't know it's so. Yeah, the other things. I think you can add impairment to. So the other things so that you can add. So that is what put is so you add it back. I mean, remember you add it back. What's the next one? You adjust for your working capital. Adjust for working capital. So what's our working capital? Our working capital is there is increase. This remember increase in account receivable. What do we do? Increase in account receivable. What do we do? Minus. If there is decrease in account receivable, we'll add. If there is increase in account payable, what do you do? We'll add. If there is a decrease in account payable, what do we do? Minus. By the time you do everything, you get what? Get your operating cash flow. Make it there. So this is it. So the other things I also bring classic operating cash flow. So I will finally do. So that is direct method and indirect method operating activities. But like I said, the investing and financing activity is the same. So there is no issue with that. Investing and financing activity is the same. So do you understand? Can I go ahead?
Calculate for different tax, different income taxes in under this method.
Okay. Okay, so is it the calculation of deferred income tax or how do we bring in deferred income tax? Okay, you know, like I said, it's quite easy. It's quite just notice the opposite side of income statement and your balance sheet. Whatever you do in your income statement and your balance sheet, it is the opposite you come and do in your cash flow. Does it make sense? So you don't even need to plan anything. Just noting those items that you're supposed to bring into your cash flow. Like this is the value income tax. Go and check the balance sheet. Once you check the balance sheet, what side is it holding? Is it an asset or a liability? If it is an asset or a current asset, that means it's an increase. Automatically, if it's an increase in the current asset, you're going to subtract it in your cash flow. If it is a liability in your balance sheet, that means it's a negative in your balance sheet. That means you're going to add it back in your cash flow. That's just it. That's it. Is that why is that?
Just for it to take place.
Okay. So we agreed that the value, we know that whatever it was implied, supposed to come into our cash flow. We will see the side it is in your income statement or your balance sheet. Once you see the side it is in, if it is a current asset or a current liability, you know that in your balance sheet, the current asset is a positive to you. Does it make sense? Is it positive to me like exactly positive to you? If it is a positive to you, since we are trying to get our cash balance back in our cash flow, you will go and subtract into your cash flow. If it is a liability in your balance sheet, that means it's a negative to your balance sheet. That means it's a minus in your balance sheet. Your cash flow one item back in your cash flow. Are you fine?
Thank you. Maybe when I still get a question, let me know that. Thank you. I'll answer some questions.
That's about you pay for what must be so like this
Look at you back. Taxes, you see a lot of time. There are different taxes. You will see why it is. Which from the tax, it's from the one. There are one things to do. Income taxes are all from the land taxes, how you remember it and you understand. I don't want to look at it that there is no conflict. What you're ready to get that. So are we good? Okay. Like I said, there's arguments in people of preferred method, but basically the best method to use is your direct method. But people still argue that no, you don't want direct method, it's easier to prepare indirect method. Then also, it's also very easy to hide whether that is your indirect method. Indirect method. Okay. So we probably come back to all these tasks, probably come back to all these questions. But before we move back, let me just do so you should tell me. I will not ask for 2 months. Let's do number 9. Number 9. Let me run it. Yes, that's it. Screen. So what about number 9, everybody?
Sorry, I just because
Okay. We all agree?
Yes.
Okay. Then let's look at number 11. Number 11. Number 11. 11. Like 1. 11. Do we agree? Okay, so that's the direct. So let's look at the other part, the investing and financing activities. Okay, so let's look at investing and financing. Okay, basically we said that investing activity has to do with acquisition and disposal, right? Yeah, that's to do with acquisition and disposal. Has to do with acquisition and disposal. Okay, so because of time, and I don't want you to stress yourself, so basically, when there is an inflow, when there is cash inflow from the sale of equipment, that is, when there is inflow from you are selling an equipment, I wish to get anybody. Cash from sale of equipment. Yes, cash from sale of equipment. How do we calculate it? Please, let's note. These are the questions they can ask you in terms of calculation under your investment. Cash from sale of investment. Investment. So it is going to be your historical cost, that's the amount of budget, your historical cost of equipment sold. Please let's note this. Equipment sold minus your depreciation of the equipment sold. All together. Plus gain on sale of equipment. Gain on sale of equipment. I will get that. Is that we already seen this? Historical cost, yes, historical cost of the equipment sold minus depreciation of the equipment sold plus gain on sale of equipment. So the question now is, how do we calculate all these things? Historical cost of the equipment. So let's start with the historical cost of the equipment sold. How do we calculate this historical cost of the equipment sold? So let's write historical cost of the equipment sold is the beginning balance. Beginning balance. So let's write everybody. Historical cost of the equipment sold is the beginning balance of the equipment. Beginning balance of the equipment plus equipment purchase. Plus equipment purchase minus ending balance of the equipment. Minus ending balance of the equipment. That's our historical cost of the equipment. Historical cost of the equipment is the beginning balance plus equipment purchase minus ending balance of the equipment. Minus ending balance. Very good. Second one is how to calculate the depreciation of the equipment sold. The depreciation of the equipment sold. So let's write beginning balance of depreciation. I will get everybody. Beginning balance of depreciation plus depreciation of the equipment plus depreciation of the equipment minus ending balance. Minus ending balance of depreciation. Minus ending balance. Minus ending balance. Minus ending balance of depreciation. Very good. So let's take this example and write it. Everybody, let's write. Let's write. Then you solve it for me and tell me your investing activity, your kind of state of it. So let's write it. Those are like, can you hear me?
Yeah, bro.
And I think one person is awful. Yeah, you look inside. Oh, okay. Oh, really, okay, so let's write. The balance sheet extract. Let's write everybody. The balance sheet extract. The balance sheet extract for A Limited. For A Limited shows the machinery and accumulated depreciation balance. The balance sheet extract for A Limited shows the machinery and accumulated depreciation balance for the year. For the year. Let me write it down. For the year. So machinery, this is 2020, it's showing 80 million. This is accumulated depreciation, that's what it means. It's showing 25 million. While in 2021, this one is 91 million and 31 million. Can you ask my students online too? Okay, let me call it for you. Okay, you see the call. I see the call. Okay, yes, it's the one that I did. So 2020, 2021 machine is 80. Not 27.5. Which one? 25. 25. I will give you 25. Yeah, written it on the board, but you can see it. Oh yeah, let me see it out. So in 2020, we did like a check, we did machine and a copy. In 2020, your machine is 80, then our related decision is 25 in 2020. Then in 2021, machine is 91, then our related decision is 31. 2020 is a machine is 80, the laminated extrusion is 25. 80 and 25. Machine is 80, the laminated extrusion is 25. Why in 2020, 2021, the machine is 91, the laminated extrusion is 31. Are we fine now? Can I go ahead?
Yes.
So further information shows the gain on sale of machine. Shows the gain on sale of machine of 1.5 million. 1.5. 1.5. Depreciation expense for 2021 is 7. Depreciation expense for 2021 is 7. While capital expenditure on machine, is 14 million. Is 14 million. Capital expenditure of machine is 14 million. How much is it? 14. 14. Yes, 1. Yes, that's 14 million. So how much did the company receive in cash from the sale of machine? How much did the company receive in cash from the sale of machine? How much did the company receive in cash from the sale of machine? So with the same formula and with the good we have a very short time, please. We have only 5 minutes. 5 minutes. Okay, I will go on. Then what did anybody get an answer? And somebody got what? 3.5. Somebody got 4.5. Okay. So you got this target.
Well, not everywhere under question.
Well, this way.
Think on that qualification. Think values, the station
Beginning balance plus depreciation plus depreciation expense minus ending balance. So fine.
and what people are trying. I want people are trying.
Okay. So how did we get 4.5? Let's quickly solve it because of time, so we can move into another step. Where you guys will supply them. So the first thing, what do we need to do? What's the formula to calculate cash control of customer, which is historical cost minus depreciation plus gain. So what is the historical cost? Let's calculate for the historical cost. Historical cost is going to be what? 80 plus capital expenditure 14 minus, is it 91? 91. So what do we have? Is it 3 million? 3. So let's do for which one is the next one? Depreciation. So how do we calculate our depreciation? 25 plus 7 minus 31. So what do we have? 1. And we have gain of how much? 1.5. 1.5. So let's put that in our formula, which is going to be what? 3 minus 1 minus 1 plus 1.5, which leads to what? 3.5. Thank you. That's good. Is it clear now, sir?
Yes, I think that just from the system.
Okay. That's good. That's good. So that is all on investing activity. Let's look at financing activities quickly. Any question, please stop me at any point in time, please. I don't want to be too fast. I want to get the concept. Let's get the concept, then if any question comes out anyway, you can be able to tap on it. So financing activities. So we said financing activity is usually our changes in capital structure. And we recognize two forms of capital, which is debt and equity, right? We are in. Okay. So debt, the money you borrow, are going to get that. So the money you borrow. So net cash flow from net cash flow. Net cash flow for creditors. From creditors. That's right. Net cash flow from this is one. This is the one that you borrow. Net cash flow from creditors. It is your new borrowings. Minus principal amount paid. Principal amount paid. So the next one is net cash flow. So we net cash flow from shareholders. Is what? Net cash flow from shareholders is your new equity issued. Minus share repurchase minus cash dividend. Please let's note it. So those are the two main forms of fund for a fund. We would have taken the interest and another part. My interest is the interest of people like it. So the addition of this one and two give you cash flow from financing activity. Cash flow from finance. Those are like fine. Can anybody?
Yes, exactly.
You know what we're doing? Income statements. We mentioned what we do. Common size analysis for income statement, right? Which is what? Your revenue, yes. What about your balance sheets? Yes, you can try common size analysis for cash. What? Common size analysis for cash. Anybody wants to try?
I think I will.
This is more like you say. So let's write. There are two ways you can do for your cash flow. One, is either you express each line of the cash flow. Each line of the cash flow, that is inflow over total inflow. Inflow over total inflow or outflow over total outflow. You pick each inflow divided by total inflow, or you pick each outflow divided by total outflow. Number 3, you can either use any one of them. Number 2. Express each line item on the percentage of revenue. And try to express each line item on the percentage of revenue. And try to express each line item percentage of revenue. So I will find out you do something. I need to go to. Oh. I see there is something.
Yes,
Okay. So now there is a major concept I want to focus on. Just let me know where you guys are ready, so we talk about the main concept. There's a main concept I want us to focus on. Yeah, so this is it. You know, and those that go for it are very well. There is something we call free cash flow to refer and free cash flow to equity. Anybody wants to help? What's free cash flow to refer and free cash flow to equity? Anybody wants to help? Anybody wants to help? It's there now. But you want me to give credit on this. I can give credit for where I think you are correct. Find credit. Can you give us the definition of where?
I think that's like okay. Free cash flow from the cash flow was that's all like something else. So that the but the just free cash flows today it's just the anything companies.
Yes. So basically, we that into the form that available to every user, anybody that's not been able to the company, every user of the company, even the company itself, that free capital for you. Why free capital to equity is just the money that is available for all, only the equity holders. Do you understand? So if logically now you have money, you can see cash. Do you understand? The cash might be tied to something, might be tied to something you want to pay. Do you understand? Or you want to pay anytime soon. So by the time you deduct all this amount, you don't make that thing, you don't. So this is what you now say, oh, so this is the total amount as a shareholder that they have. You know that okay, so let me do 50% of it as dividend, and the remaining 50% of it less that we retain dividends. Do you understand? So that's this about this work. It's very important. I'm really sure that go for it that is very great. So you ask me this question a lot. Since you have to go and you push it very well, and that when you get to the ministry, your own policy. Okay, so let's now look at this question. This is out of so free cash flow to revenue. Please, if there's any question, please ask me. Free cash flow to cash. How do you calculate free cash flow to cash? Free cash flow. Free cash flow. See, the thing is, are you fine? What am I doing? Okay, sorry. Please, the thing is, it still remains the same formula. Remember, we have operating plus investing plus financing. Please, are you up for it? Just on line. Okay. Thank you very much. Free cash flow different. Remember, we have operating plus investing plus financing. Please, let's decompose this operating. Operating with net income plus. I will get that. Please, you don't need to cram. Just notice this. Non-cash charges. I will get it. Non-cash charges plus what there is after your non-cash. Your working capital. Working capital investment. Is it plus or minus? You guys are not following. I guys following. Okay. Net income plus NCC minus working capital investment. This is our operating activity. Let's move to our investing activity. What's our investing activity? Our investing activity, it is what? Our fixed term cost that we investing at all those acquisition, which is going to be plus our financing activity, which is going to be plus interest 1 minus tax. This is the formula. You don't need to cry. Just know it with operating, investing, and financing. So this part, you can also see this part. This net income, working capital, and fixed income can also be what? Net income to working capital can also be what? Cash flow from operating. Yes, plus fixed capital investment, plus interest 1 minus tax. Is it clear? Those are like fine. Is it easy to remember? I think it's easy to remember actually, right?
Yes.
So you guys know the right thing. Can I move to free cash flow to so any question?
Why don't we
In non-cash and this is a decision. Decision was subtract from my decision like normally the decision don't subtract. I didn't have to that's exactly what yes, one capital is really that goal, like the receivings and all that. Yes, so that's also let's continue now. So free cash flow to empty. So you understand this pattern. So it's still almost the same thing. So let me rub this off now. So you guys can now try and help me with the free cash flow to empty. Free cash flow to equity. So yeah, now let's take it the same way. Operating is going to be what? Net income. Where everybody on mute your mind. Net income. Where now? Plus what? NCC. Non-cash charges. Then the next one is what? Minus working capital investment. That is the operating activity. Let's move to the investing activity. This so we are doing free cash flow to equity now. Investing activity is going to be what? That's going to be FC investing. Yes, so this is now the one that will change now, the financing activity. Financing activity will now be plus net borrowing or minus net debt repayment. Does it make sense? You can't have two at the same time. You know, just one that you have. You understand? You can't have two, so just one. Net borrowing. You remember we said whatever you're doing in your balance sheet is your property. Money is coming in your balance sheet or your whatever. The money is coming in. Net borrowing. You understand? So that means your is it money borrowing? Net borrowing. You understand? So that's net borrowing and your net debt repayment. Does it make sense? Everybody? So that's free cash flow to equity, free cash flow to free cash flow to equity, and free cash flow to okay, so those are my findings. How does it screen now? Hello. Okay, so let's quickly solve. Let's quickly solve all these questions. Let's run through them. Let's run through them. Quickly. So you give me the answer. Okay, but let's unmute and quickly give me the answer. So no need to financial issues. So you will see that they are almost the same. So number one, everybody, number one. Number one. Quickly. I can't hear from those online. Number one. Okay, so number two. Number three.
Hey, sorry. That should be interesting.
Number three.
That should be B.
Sorry, no sleep.
I'm sorry, I was thinking A.
Yeah, you're going for A. That's number three.
Yes, not true.
Yes, B.
Is what?
A.
What of Esther? Which one are you going for number three? A. Okay. I go for B now. Number three is B. So explain why you choose B, and Esther is explain why you choose B.
Okay, it's a manufacturing company, right? So getting benefits. I feel when I choose A. So purchase of securities to sounds more like an investing activities, held for trading. And even though securities are held for trading, it is not the primary activities of that manufacturing company. Right. Also, the same goes for also purchase of security held for investments. That's why I'm doing it A.
Okay, so first of all, what you look at is you will know that it's a manufacturing organization. I mean,
Yeah.
Yes. Yes.
it's a manufacturing organization. Yes, and we know that purchase of securities held for trade. So it's already clear, they told you already that it's held for trade. Do you understand? They told you already that the security they are holding is for trading. It's for their operations. So that argument can go for two. Can go for investing, and that number item two can go for what do you call it? Option and claim. Do you understand? But since we're told that this one is held for trade, that means it's held for their normal, all you are holding is really for is to sell. Is it clear?
Okay.
Okay.
So what do you think the answer will be with that?
Looks like only I can remember.
Because it still cannot be the answer.
Exactly. So Esther, are you fine now?
Yeah, for me.
Okay, so number 4, quickly, number 4.
The first one is what we are
See,
We are use all that everybody online. Those are that.
Yes, see.
Yes, see. Remember we said non-cash operating investing of financing activity. It's not usually booked in the cash flow. We think that's supplementary and notary. That's what we wait for. Number 5, quickly.
the company is just or my man, speaking.
See.
Number 5, see, right? Everybody will be agree.
Yes, see.
Okay, so number 6, quickly. Everybody that's all your number 6. Number 6. Remember we've done this, just remember right form and you have everything completing except dividend A, which is
Sim.
number 7, quickly.
Interest rate is required as principal account of you know see real account. What would be classified as without which one of the ones yeah.
So number what are you number 7?
I'll have to see.
Those everybody else is then somebody has said C here, which one are you going for?
oh yeah,
See.
still wrong.
Okay, number 8. 8 and 9, quickly. 8, 9, 10. Quickly everybody. 8, 9, 10.
Number 9, C. Number 10, A.
And one thing,
Number 9 is C, number 10 A. Okay, quickly.
Number 8, Steve,
Okay, you can see that thing. Number 10, you can see what I said. We are only most likely to affect operating spectrum cash flow using indirectly. Yeah, good. Okay, you guys are there. So let's do number 12. Let's do number 12. Number 12. No, number 12.
Passport,
C. Trust.
Okay, we are waiting for one more person. So, okay. Okay, what's it? That's number 13. Let's click to number 13. So just remember that rule. You can see there are a lot of these questions that you need to stress yourself. Number 13.
A, A.
Okay, I want you guys to You can see it's that easy. You see what I'm saying? It's just easy. Once you know the sign, put the sign, and you get to understand. You can see that easy. Yeah, I'm waiting for that to number 13. Okay. So, should we still continue? Oh yeah, let's do number 15. Let's do number 15. That's what? That's what I'm saying, right? 15, number 15.
You still see.
Okay. Okay. So you can see it's quite easy, everyone. Very easy. It's the same technique for all of them. The same technique for all of them. Just follow the rules. They are fine. Please, any question? Before we move into, let me see the next topic. Any question? So let's continue then. Since there's no question or anything more than I think that good. So let's go back to our shares and groups. I was making that one. So financial ratios now, very interesting topic. And you definitely need this data on even anything between FRA and 2 and so on minutes. Okay, so what I'll do is I'm going to give you some rules. So once you are familiar with those rules, you need to apply those rules with our ratios. Are we good everybody? Once you are good with those rules, you don't need to plan those formulas. Once you are good with those rules, you will be fine. Can we start, anybody?
Yes, Master.
Okay, thank you very much. So financial ratios. Financial ratios. Financial ratios. So every ratio has number one, numerator, and what? Denominator. Please, let's note this one, please. Please, row one. Numerator and denominator. So if your numerator is going up, are we together, everybody? If your numerator is going up, your ratio will go up. That means your numerator has a direct relationship with your ratio. Does that make sense, everybody? I need to hear confirmation from you guys. Okay. So if your numerator is going up, your ratio will go up. If your numerator is going down, what happens to your ratio? It will go down. So your numerator has a direct relationship with your ratio. That's the first thing. Look at this one, your denominator. The second one, your denominator. Your denominator. If your denominator is going up, your ratio will go down. That means your denominator has an inverse relationship with your ratio. If your denominator goes up, your ratio will go down. If your denominator is going down, what happens to your ratio? It's going to go up. Does it make sense, everybody?
Yes, but
Okay, thank you. So rule 2 now. Rule 2. Rule 2. Rule 2. Rule 2. It's also known as rules. There is no ratio you cannot solve. Any ratio. Don't need to cram them. They are fine. Rule 2 now. I'm sure everybody has written rule 1 now. Rule 2. Rule 2. Rule 2. If you see anything that is X margin or anything margin, you see X margin or anything margin, it is going to be that X over revenue. Anything margin. So look at the example of margin, anything margin. Oh yeah, gross margin.
Gross margin.
Yes, it's going to be your gross profit or gross profit margin, I mean, gross profit margin. It's going to be your gross profit over what? Revenue. Operating profit margin. Operating profit over revenue. Net profit margin. Net profit over revenue. Can I move? I should move to rule 3, right?
So everything margin is that thing over revenue.
Exactly.
Thank you.
Are we good? Can I go ahead? Okay, rule 3 now. Rule 3. Rule 3. Rule 3. Rule 3. X turnover. X turnover. So anything turnover, that means turnover will come up, which is going to be your revenue. Another name for turnover is what? Revenue, I mean. So turnover will go up, then X will come down, just like you turning it upside down. X turnover. Revenue goes up, X come down. Are we good? So this one has exception. There are 2 exceptions to this X turnover. Please, let's take note. 2 exceptions to this X turnover. Number 1, payables turnover. Then inventory turnover. So, payables is related to what, everybody? Do you remember? Payables is related to what in your income statement? Well, talk to me now. Payables is related to what in your income statement? No. Payables is related to what in your income statement? No. Purchases. Thank you. Purchases. While cost of inventory is related to what?
Okay, cost of
Cost of goods sold. No. So this is the 2 only exception. So instead of using revenue for this one, it will be this one. So if you are saying for payables turnover, turnover goes up. Instead of using revenue, it will now be what?
Purchases.
Purchases. Thank you. Over what? Payables. Likewise, inventory turnover, it will now be what? And it will now be cost of goods sold over what? Inventory. Are we finding it? But it doesn't like. Any questions on this? Any question? Any question? Any question? Any question? Okay, that's it. So the next one, what number are we now? What number? What rule are we now? 4. Rule 4. Those ones are you following me? Okay. Rule 4. So if you see x on y or x to y, are we together? Or x per y, it is equal to your x over y. Are you good?
Yeah.
Okay. Can I move to the next rule? Rule 5 now, right? Rule 5. Rule 5. Rule 5. Whatever. Please, let's pay attention to this particular one. All the items that come from your balance sheet, you usually use average. Please, for the purpose of CFA, for you to pass this exam, please, you use average. If it is your income statement, you use that particular item in loan, that particular year in loan. If you are not given average, please don't go and formulate your own average and start adding up. Please. Please, if you are given average, that's what you use average. If you are not given, please, just use what you are given like that. Please. For your item in your balance sheet is usually average. Please, let's take a look. How to get that?
We should use average if like you don't have weight.
Exactly. But if you are not given that much, you neglect.
People have to
You use what you have. Exactly.
okay. Now, why are you considering you use the amount?
Yes, the amount for that particular year.
Okay, thank you.
Can we move? Everybody do some time.
You don't know if you are making
Okay. Just start then. We are fine.
Yes.
Okay. So X yield. X yield. X yield. So it is that X over market price. Eh?
Rule 6, Abi.
Yes, I think it's rule 6.
Yes, understood.
Yes, it is X yield. It is going to be X over market price. Market price. So let's say dividend yield. Example, dividend yield. It is dividend over market price. Cash flow yield. It is dividend. It is cash flow over market price.
That's your useful activity. You got to do already.
It will be clear. It will be clear in two.
Okay,
That is well. I'm fine. Can I continue?
Good.
So you remember we gave average, right? Average. You said all balance sheet items are usually at average, right? Are we together, everybody? We said all balance sheet items are usually on average. Abi? Okay, so exception to that rule is liquidity ratios. Liquidity ratios. So liquidity ratios will not take up average. Abi? So one of the first liquidity ratio is current ratio. Abi? Current ratio. Who wants to help you with current ratio?
Yeah, current assets are
Okay. So quick ratio. Who wants to help me?
current assets less one over current liabilities.
Cash ratio. Most level. Okay, so for the purpose of this exam, for the purpose of CFA, whatever you know about current ratio or quick ratio, please let's discard it. For the purpose of this exam. So your current ratio from now on, please, are we together, everybody?
Yes.
It is now going to be C Mr. I over your what? Current ratio, over your current liability. But if you are not given this separately, it is going to be your current asset. Your C is your cash. M is your marketable securities. R is your receivables. Then I is your inventory. Those are the fine. Cash plus marketable securities plus receivables plus inventory. Please, if it's not multiplication, don't multiply it well. If you multiply it and you get a big figure, we come back and it's so hard to get out. Don't multiply it. You like them?
Huh?
I thought you said
No. The first one very much.
that is current ratio. Quick ratio. Quick ratio. You know, we said our initially what we were saying quick ratio is current asset minus inventory. Do you remember what we said, everybody?
Sure.
Okay, so it is, at that point, you forget what we learned. So it's now going to be C Mr. over your current liabilities. That is cash plus marketable securities plus receivables divided by your current liability. I just start there. Can I get that for you? Okay. So the last one is cash ratio, which is CM over current liabilities, which is cash plus marketable securities divided by the current liabilities. Okay. Okay, so the next one, what will be the next one? What rule is the next one? What number are we now? Rule what?
Right.
Rule 8. 7. Okay, whichever one, 7 or 8, anyone. So the next one is X cover. X cover. Whenever you see X cover, please let's look at this hypothetical income statement. So N is before interest and tax, Abi, that's operating income, Abi. What do we do? We remove our interest, Abi. Oh yeah, now everybody now. Stop saying. What do we get after that? N is before tax, Abi. Then what do we do? We remove tax, Abi. We remove tax, Abi. We now get earnings after tax or profit after tax, Abi. Good. Good. So just remember X cover. X cover means what is covering X. Are we together? What is covering X? So look at this example now. If you see tax cover, what is covering tax? Thank you, bros. Wisdom is too much for you. So it is going to be earnings before tax over tax. Does it make sense? Just online. Are you fine? So just look at whatever you X cover, just look at what is covering this X from this hypothetical income statement that we have. I will give example, tax cover, tax. What is covering tax? What is shielding tax? What is covering tax? And what is covering it is earnings before tax. Does it make sense? Esther, are you there?
Yeah, okay.
Okay, yeah, so see tax cover, anything that is covering tax, I mean, hey, look at this one now. Interest cover. So we should be able to help you with this. Interest cover.
Any before interest from tax.
Divided by what?
Interest.
Thank you. Any before interest and tax. Divided by what? Interest.
You have to do this, not small, I think, in interest. Well, the tax only will be small, I think, in interest.
Yes. This is what is covering each one of them. Those are like fine. Let's now look at this last one. Like people used to run away from this one. Can I run this one off now? Let me clear this one. I'm sure you guys have written it. So let's look at this one. Fixed charge cover. Fixed charge cover. What are the two fixed charge that the company usually have? Who wants to try? Two fixed charge that the company usually have. Two fixed charge that the company usually have.
Interest on bond and interest on previous share, and interest of director.
Okay, anybody else wants to try?
Well, let's see the fixed cost of the production.
Okay, fixed cost, like what?
Rents.
Rents. Hey, so you got the first one. You got the first one. The first fixed cost charge is interest. And somebody has come up with the other one, which is rent or leases. That is the two fixed cost charge. And we said our fixed charge cover is what is covering our fixed charge. I mean, what is covering our fixed charge? And you know we have interest here, I mean. So it is going to be EBIT over what? Interest. There's one more thing that is missing. Talk to me now. There's one more thing that is missing. That we don't have here. Oh yeah, now those online help me now. That we mentioned out of here. Interest. You mentioned use interest. What's the last one? Leases, I mean.
Yeah.
So to get the thing that is covering this fixed charge, we'll add back leases here, lease payment, then lease payment. Does it make sense? Please, over years, I've seen people make this mistake. They will cancel out these lease payments. It's wrong, oh. You're on your own. I will see your answer there. Your answer will be your question. You are wrong. Because looking at it, this is board math now. You can't divide, you just follow the rule of board math. Bracket, or division, multiplication, addition, then subtraction. Does it make sense, everybody? Am I speaking to myself? Or are you people angry?
Okay, well, I get back.
No, we're going to use that. Yeah, you're going to make a note.
Eh?
I can about we also have to area.
Exactly. Thank you. So any before interest attack plus this payment divided by interest plus this payment. Please, you don't what's the call? You don't divide into, please. If you divide into on your own, you're on your own. Yes, sir.
Is every plus lease interest?
Yes. Lease payment, lease interest payment, or lease payment. Let's do lease payment. But it will play your exam, not from this.
Yeah, divided by
Interest plus lease payment. Yes. Those are the two fixed charge. Yes.
So we had it back of, and we had it back interest.
Exactly. Exactly. Okay. Please, like I said, you don't divide the lease payment divided by lease payment. If you divide it to your own, that means we are trying to do interest cover. Do you understand? So it's wrong, though, please. You don't divide it, you add it. You first add every plus lease payment, put your figure in one place. Interest plus lease payment, put your figure. You do not divide numerator by the denominator. Get your answer. So that will be all for now. That will be all for now. So we'll now move on to our ratios. Please, let's do all this one, then we'll come back to the bond analysis as we are doing our ratios. So let's continue. To describe the tools and techniques used in financial analysis, including their uses and limitation. So let's write everybody. So ratios is very important. We're now starting the ratio proper. Ratio is very important. It helps give meaning to so many things, even our, you having, what is it called? You having that, like I said, accounting is now becoming funny. People usually go into accounting. It's looked at and take the meaning of these figures. You are looking at it nowadays, we have a software that will read, that will prepare accounting, that will prepare financial statements, even with ease. Or like a normal accountant that will try and balancing from they know how to balance everything journal, balance this on journal. But with account with a software, it's limited error. It's what you process in that you get. So it's what you feed the computer that you get. You don't see the right information, you get out the right information also. So most of our shifting from like manual preparation of account to system preparation of account. So it is people that can actually make meaning of these items. That is what people are looking for. Jonathan. So there are different ways in which you can make meaning of figures. One of them is, let's write number one, ratios. Number one, ratios. Number two, common size analysis. Common size analysis. Three, graphical analysis. Graphical analysis. While four, regression analysis. Regression analysis. So we thought about all this one by one. Ratios, common size analysis, graphical analysis, and regression analysis. Regression analysis. So ratios are very common. They are all those are the things we don't from basically. Number one, there are uses of ratios to express relationship among data. Look at it, for instance, one of the things you can do ratios for is to project future earnings. Imagine you want to project your, so you see your profit, and so you now want to people, so the next 10 years, what would likely be our ratio? What would likely be our profit? So with ratio can assist in projecting future earnings. So number two, evaluate the firm's flexibility. Evaluate the firm's flexibility. Flexibility in terms of like, so if you want to acquire a new project, if you want to pay salaries and so on, ratios can help. So your level of cash is available. Or better for you to be just stop for now. Oh, we need to cut down the salaries, we need to increase salaries and so on. So with ratios, you can easily determine that. Number three, helps us assess management performance. You can see what I can do. You can see any profit project which our MD, our CFA is performing well. So these are things you can help, ratio can help us assess management performance. So it helps us compare figures within industry. Imagine that you don't build or total, but comparing their figures within industry. Or that is saying that in GTP, they are comparing their figures within industry. Or looking at maybe a PwC and a KPMG, or even do their financial statements, they are not in this company, very difficult to get. You understand? So those ones, we want to say that KPMG and the so let's see. I think they are performing. So this what so can easily compare their resources within industry, people within industry, and see what invests in the trading. So what are the limitations of ratios? Who wants to help? Anybody wants to help? Limitations of ratios. So viewing ratios in isolation does not make sense. You just put down people, current asset divided by current liability. So what does it mean? So it is except you are comparing maybe historical performance or maybe income against another company, or before you can now actually make sense or you have a benchmark. Do you understand? If you put figures, what does that figure now mean? Doesn't mean that it's good, it doesn't mean that it's bad. So what does that figure say? So looking at figures in ratios in isolation doesn't really make sense. So number two, comparing companies with companies. Imagine you are comparing a UK company and a US company. Do you understand? And maybe the way we talked about it, maybe that US company is using live food, and that UK company is using five food. It will be difficult to compare. Do you understand? Or maybe that US company is using valuation, while the UK company is using cost to level. So different accounting methods or ratios will be difficult to compare ratios. I will get everyone just on that.
Yes.
Okay. So at what point do we determine this is enough? Is it that when you have so much cash? Is it that when you like for instance now you know that cash is good to be liquid. But once you have too much cash, then it's bad. Because it just shows that the accountant is not thinking, they're just putting money in the bank. Do you understand? When you can get it and want to invest, for maybe one fine, but at least if the accountant is not thinking properly, you can look for trading pillar, just put it in trading pillar and looking at it. Then it's a guaranteed return. Do you understand? Yeah? So with that, it's difficult to identify this is the target you want to achieve. So looking at it, this is a long target. That's the you have 50 million in the account, it's enough. If you say you have 7 million, you say so those are appearance ratios cannot be defined. So there are so many other disadvantages. I don't think people also think of. Okay, another issue, I'm expecting someone to help me with it. Definition of ratio is difficult. Some of you might say, oh, it is current asset divided by your current liability. Me, I give you another one, I say the C Mr. High divided. So you understand? So everybody can define their ratios anyhow. Do you understand? Can come up and say, oh, my own ratio, this is what I want it to be. You understand? This is what I want my ratios to be. And another thing you can look at ratios can be easily manipulated. Imagine I want to present to the board now, and I know that my net profit is not good. Instead of using net profit, I can use operating profit, so I will boost that particular ratio very clearly. Does it make sense for that? I think so.
Yeah, no,
Okay. So ratios can be easily manipulated. You can decide to boost a particular ratio and you guys know that, oh, so they will think about performance, but that is not the true position. It is actually part of the position, but if you look for it, it's very easy way to manipulate it and make it look very good.
But
You understand?
but
Yeah.
in operating profits, you are going to this one. We are saying every profit margin.
No, you don't say it's a profit margin. What's the profit margin? It's going to be say, whatever the data they flow, it's able to that. So what profit with this one? That is operating profit. You boosted your revenue before you boosted your margin. And people will be like, oh, this guy is performing correct. But the net profit is very poor. So that's the first form of analysis ratios. Another one is common size analysis. We talked about common size analysis, but now we're not going to expand on that. There are two forms of common size analysis. It's either there is vertical common size analysis or horizontal common size analysis. Are we together, everybody? This one.
yeah.
So vertical common size analysis is the normal one. When you help me, income statement, what's the vertical common size analysis? Let me see. We divide it by revenue. For balance sheet, vertical common size analysis for your balance sheet. Percentage of but so what by your cash do everybody? For each outflow to total outflow, then the second one is divide it silently by your revenue. Okay, that is your vertical size analysis. Why horizontal common size analysis? Horizontal common size analysis. I'll just get everyone. So you make a particular year your base year. Once you make a particular year your base year, you can now start comparing. Do you understand? You can now make that. So let's look at this example now. Let's look at this hypothetical example. Let me see if we have any financial statement here. Okay. So let's look at this one now, for instance now. Are we together? Let's say look at this one now. In 2015, 2016, 2017, let's say revenue revenue is 10, 25, while your cost of goods sold is 7, 14, and maybe 3. Then your gross margin is what? This one is 3, 6, 2. Are we together? Can you all see my screen, anybody? So what horizontal common size analysis is saying is, you make 1 year your particular, your base year. So which year should we use as our base year here? Which year should we use as our base year? No, 2017. This is okay. 2015, 2016, and 2017. But yeah, which year should we use as our base year? 2015. So see, if it is 2015 that is our base year, 2015 is our base year. So what should, so your revenue, your horizontal common size analysis will now be what? Revenue, what should? It is going to be, for 2015, it's going to be 10 divided by 10, which is going to be what? 1. Your cost of goods sold is going to be 7 divided by 10, which is going to be what? 7 divided by 7, sorry. 7 divided by 7, which is going to be 1. While your gross margin is going to be what? 3 divided by 3, which is going to be 1. Now, let's look at 2016. 2015 is our base year, Abby. So 2016 is going to be 10 divided by 20, which is going to be what? 2. Is it 2? No, 10 divided by 20. So that is our base year. Oh, sorry. It's 20 divided by 10. Yeah, 20 divided by 10 is going to be 2. Like cost of goods sold, 14 divided by 7 is going to be what? 2. While gross margin is going to be what? 2. 2017 is going to be what?
0.5.
0.5. 0.5.
And 2 divided by
1.5. Those are like fine.
Yes.
It's also 0.5.
Those are not 0.4.
0.42. So with this now, you can now compare. That's right. Using 2015 as our base year, we can see that in 2016 we performed much better. Looking at 2017, everything was a bit low. Do you understand? As against our base year. So you make a particular year your base year. Those one are you fine?
Yes.
Is it too much to battle? Let's stop here today.
One is one level. I have the absolutes.
Yeah, they're trying to make it realistic. They're trying to see it. Yeah.
So you're not going to know of absolutes.
Yeah. Yes. Those are like fine. So we stop there today. You guys are not paying attention to me. You people are watching me, brother.
No, only 2 years now.
Okay, does it make sense, everybody? Are we good? That is horizontal on one side. Horizontal. Okay, so that is the second way of which you can analyze. Let's look at the third way, which is what wants to help me. We mentioned these ratios, graphical analysis. Yeah, so graphical analysis. So if you take a graph, you can prepare bar charts. Pie chart, you can do your receivables over a period of time. You can do this with people in Excel, your PowerPoint, those are PowerPoint. You can use your PowerPoint to do graphs. Just show you your revenue has grown over 5 years. But there's no way you can ask you get a graph in your exam, please. It's just for you to know that you can do analysis with your graph. Do you understand? You can do revenue over 10 years, profit over 15 years. Draw your line graph, see the way it is growing. But as I'm very interested, that's all those people that are good with data, they just draw it for you know with Excel, with PowerPoint. To look very nice, That's it. You can see example here. Can see example here in this. Can see this is a very good example of graphs, bar charts, pie charts, histogram. You understand? Don't draw it, it's interesting. When you just our page is growing. our cash flow is going down. So you can see the line here, this is like a graph. This line showing the going table, this and so on. Do you understand? I will get everybody. Lastly, regression analysis. Regression analysis. Very interesting. You do regression analysis in level 2. Regression analysis, very interesting. So somebody can just come up with and say, oh, every day, people, those that watch for many ways, every day they're asking when they're getting just usually good. So you now want to take sample and just confirm one time. What you just do is, you now probably wake up and just say, oh, every day that ask where they are getting just usually good. You now look at history, look at their Premier League history and say, oh, they are way compare the number of times they play with their yellow jersey. So if you just focus on after taking like 25 years sample, I see that 70% of time when Arsenal where they are getting jerseys, they usually good. Or you can see when Ogadami used to come, every time Ogadami comes to pure, what is it called? 3D. When it comes around, there is usually what is it called? Rain. You understand? I take that so many times I think come, you just like, oh, like yes, it's now you're around for 5 times. So it's oh, 4 times out of the time again, there is raining. Do you understand? So do that, that's regression and just trying to make relationship out of things. I won't get anybody.
Yes.
Does it make
You have very fun to do.
okay? So those are the 4 ways in which you can do good analysis. So the key points we are going to talk about is linked to ratios, which will give you the main ratios here. But I'll give you the fundamental foundation of those ratios. Then we'll now start with ratios in detail. But before we go, let's write this thing down. Let's write the difference between cross-sectional and time series. Cross-sectional analysis. We take two cross-sectional analysis. Cross-sectional has to do with comparing 2 or more companies during the same time period. Cross-sectional analysis has to do with comparing 2 or more companies during the same time period. Cross-sectional analysis has to do with comparing 2 or more companies during the same time period. Comparing 2 or more companies during the same time period. Are we good? While time series, looking at trends over time. Looking at trends over time, that's time series. Looking at trends over time, that's time series. That's trend and time series.